Hello, listeners, and welcome back to our podcast. Before we start today's interview, I wanted to remind you we're having our annual meeting in Las Vegas, September the 1st through the 5th, called Ortho on the Strip. We asked PAOS members to share their favorite part of the conference. Here's what they had to say.
I got to sit in on some amazing lectures. The speakers that they had ranged from all different backgrounds. I also got to do a little clinical application of casting and splinting. So it was really cool to also have that hands-on experience.
The conference was a wonderful experience, and it was definitely rewarding to meet people that share my interest and passion for orthopedics, and I think I made a lot of great connections and got a lot of good advice.
It's so great to get to network, but also just great to kind of see what the foundation and, the PAOS is doing. So it was a really fun time.
And I will say they also had an awesome breakout session for new PAs who were in the clinical setting for less than 5 years, and getting to hear their experience was also invaluable.
I hope to see you there, September the 1st through the 5th. Please sign up as the spots are going quickly. Welcome to the orthoPAC podcast with your hosts Sam Dyer, Chuck Dowell, and Miles Gilbreth. Please join us as we attempt to fill in the gaps between education, current events, and real-world practice. Welcome back, listeners. Today we continue our conversation with Kristin Burton regarding personal finance, retirement, and other financial strategies. What do you think about financial advisors and kind of flipping back on that a little bit, individual equities versus indexing, both equities and bonds? And then the last part of that, the whole group investing.
Yeah, it's funny you mentioned that. A group tonight that are private equity syndicators for large multifamily. And so we're doing a large event about private equity syndications, but we've invested in one, and it's a great way to create passive income, but there's risk associated. They tend to be investments that, first off, you have to usually be an accredited investor to access. And second off, there's a genuine risk of entire loss of principal, like all of your capital, which is the nature of being an accredited investor. The SEC assumes that you can, review these deals yourself and do due diligence yourself. And in addition, you put yourself at risk of capital calls if the operators or the GPs end up needing more money than anticipated. And that's kind of part of the contract, is that you could be required to participate in a capital call. So there are downsides to that type of investment. Syndications, again, are, I would say, for most people, a little bit further down the line. Again, you have to typically qualify as an accredited investor, and that takes some time. You either have to have a net worth exceeding $1 million, excluding primary residence, or you have to meet income criteria in order to be qualified by the SEC. They have different income criteria if you're single or married. If you're single, it's $200,000. If you have a spouse or partner, it's $300,000. But there's metrics you have to meet typically to gain access. So while it's a valid modality for passive income, I would again kind of place it further down the line, even beyond buying physical real estate. But back to your question before, financial advisors, this is really more applicable to somebody who is maybe a little bit earlier on in their career and making a decision on whether or not they should employ a financial advisor for their plan. I'm not by any means against financial advisors. There's obviously an assets under management fee most of the time for them to manage your funds. And so the question really becomes, at what point does the value exceed the cost? This has been studied. Actually, Vanguard has some data on this, on how they estimate the return on cost for a financial advisor. Where it doesn't come from, I'll tell you, is from their ability to choose funds that outperform the index over the long term. That's where it does not come from. Vanguard agrees with that. And there's plenty of data saying that. There's a SPIVA report that comes out every year that looks at the ability of actively managed funds to outperform passive over long periods. It's just not there. And so the value is not going to come from them saying, hey, I can achieve these better stock market returns than you investing in index funds. If you hear that, I would probably run. Most of the value comes in two ways. One, from helping to plan a distribution strategy. and two, from preventing you from doing really crazy things in market downturns and like the behavioral side, which is funny because if in theory you can prevent that yourself, if you can control your emotions and invest in the an approach that's systematic, like dollar cost averaging, for example, and not go crazy when the market declines and not sell all your assets and go to cash, then you would fall under the group of people that I would say, I personally don't think that the value outweighs the cost until you have amassed a significant portfolio where there's some genuine complexity, like maybe you have, $500,000 invested, and or you're in the landing the plane mode, meaning you're genuinely deciding what's my distribution going to look like, what's my retirement spending going to look like, what's my social security strategy going to look like. Those things are areas where financial advisors can add tremendous amount of value. I would also add some can be helpful too if you have an interest in investing in alternative asset classes and they have experience doing due diligence on those deals, which is not an across the board truth for financial advisors. And frankly, many medical professionals never invest in alternatives. And so for the average person, the saying, hey, I have a big portfolio, 500,000 plus, and or I'm going to live on assets in the next 5 years, there's a lot of room for value add. That doesn't apply to someone who's 2 years out. Most of their investing is split between their employer retirement account and a Roth IRA, for example. And to be frank, you could go to Fidelity and open a zero cost Roth IRA, no account fees. You could go invest in one of their zero expense index funds and have a 2 or 3 fund portfolio with no fees whatsoever. You'll come out ahead. I just think you have to sit back and go, where am I in my financial journey? What level of complexity do I have? And at what point does the value exceed the cost for me? Most people just don't know how to invest. And so their decision to use a financial advisor is based on the fact that they don't know how and they don't want to learn. And so there's not really a value cost proposition that comes into play. It's a simple, oh gosh, I don't know, I'm going to offload it. Where I think the people who can benefit the most from financial advisors are actually people who've taken the time to increase their own financial literacy, built their own portfolio. And then when you go to sit at a table, it's a very different conversation because you have a baseline knowledge. You can have a back and forth and say, hey, look, I got myself here. Now I have some complexity. Can you take me there? And you don't feel like you're blindly following someone else's advice without having any reference points for yourself on whether or not this might be a good idea for you.
I would have one comment on financial advisors. Make sure it's a fiduciary,
Mm.
somebody who's going to do well when you do well. Somebody that's trying to sell you their products is probably not where you want to go.
Yeah.
Yeah.
An
So
insurance salesman, that's not what you're looking for.
I think that's phenomenal advice on financial advisors, and it's one that's been mirrored or said to me several times by multiple different financial advisors about, making sure that you build your own financial literacy when your investment portfolio is simple and growth based in your early career. You can do it on your own, but when you start to come up to retirement and think about estate planning and think about retirement income, that's a time that it's good to shift into a financial advisor. So I think that's great advice. A couple of things that are comments from earlier. One, I would be very interested to see your Excel spreadsheet. Um, I would like to consider myself relatively good with money. As people laugh, I always say, if you spend less money than you make, you'll never not have money. But that's not a strategy that works in retirement, right? Um, so I've been very resistant forever in making a budget, although while still putting away money for retirement, still investing, still buying a house. That my goal with this one would be that this becomes a rental property. It's in a location that I think would rent. And so when I'm ready to outgrow this house, I don't want to have to tap into this equity for my next one. So I think that's the way that I realistically thought about getting into real estate, was first the one that I live in. But I want to see your spreadsheet. Uh, if you don't mind, like I will sit down and do a budget, which I'd never done before, because for whatever reason, it just scares me, even though it shouldn't, right? And probably what I'm looking to find out is, am I investing enough? Because I think, I lean more towards on high yield CDs, things of that nature, things that are very safe growth and probably have too much, straight quote unquote cash asset. And so, yeah, I'm interested in that.
Yeah, I'd love it. I'll send it over. It's funny. There is a group of people, it sounds like you're squarely in them, who are like, by no means is financial discipline really the problem. You know what I mean? It's like, oh gosh, I'm just a little bit hesitant to invest in some of the stuff that feels a little bit higher risk, and, safe stuff like CDs, or even just dropping money in a high yield savings account and kind of squirreling it away. It feels good. I do think you're in the minority. Most people, I think, honestly spend, oh, at least 90% of income, as I've just looked through, got probably thousands of budgets. So you're in the minority there, but there is a camp of medical professionals who is exactly like that.
Yeah, just resistant.
I want to throw in something along with the real estate. It's important to be diversified. Now, that doesn't mean necessarily just in equities. It's important to be diversified, like when you're looking to draw some things back. Like I have 4 or 5 different income streams that are, going to pay me while I'm not working. And that's important to have, because if you've lived through in 2008 when half of my portfolio went away,
Uh-huh.
that was extremely painful. And you cannot emphasize enough the psychological damage that that does to you. I mean, you just kind of, I was like a deer in the headlights. Now I got it back, but that takes a long time. And they say, this is an old saying, that, the stock market takes the stairs up and the escalator down, or the elevator down. That's the truth. I mean, 10% gone in like 2 weeks or something. It's just, you have to be aware of that, and you have to be able to know yourself that you're going to be able to live through that and not do anything drastic, because that's,
Yeah.
when you get scared and you do something crazy like sell all your stuff when it's low, that's when you lose your money. So you have to have different things. And I think real estate's a good source to have, a different income stream.
Yeah, you make a good point. Actually, inside our coaching program, I have everyone go through an exercise of figuring out, like, of course, when we think of asset allocation, a lot of times we're thinking about a stock bond portfolio. And you're looking like, okay, within equities, what do I have in large cap, domestic? What do I have in mid cap? What do I have in small cap? What do I have in international? But even way beyond that, I built out, I call it a net worth visualizer, where it actually breaks down like, hey, what is my true asset allocation across all asset classes now? And then what's my goal one? And so it'll look at like what percent of my net worth is in equities as a whole, but then what percent is in fixed income, what percent is in cash or cash equivalents, what percent is in investment real estate, what percent is in use assets like your primary residence or your car, what percent is in private equities. And so you can look through and then go, okay, when I look at this, most of my net worth is actually in my primary residence, or mostly it's all in the stock market. Maybe my goal net worth visualizer over the next 10 years has a shift where I have more investment real estate. Maybe I have private equity built in, or some other type of asset class to diversify the big picture, even beyond the idea of having a diversified stock portfolio.
Listeners, tune in next week where we continue our discussion with Kristin Burton, talking about finance and retirement and other strategies, how to manage your income. We're having our annual meeting in Las Vegas called Ortho on the Strip. We would love to see you there. Please sign up and register, as the spots are going quickly.